Well, good afternoon, everyone. This is Nina Olson, and I'm the Executive Director of the Center for Taxpayer Rights. And this is our first workshop session in our series on reimagining tax administration, state tax practices, and taxpayer rights. And this workshop series is funded by the Rockefeller Foundation, which has been supporting us to really try to look at practices that are going on both at the federal level, but also at the state level, and how we can improve those practices or celebrate really good practices. The session today, there are 4 sessions, just a little bit of administrative stuff, is that we do have an active chat. So you can put things in the chat as people are speaking and you have comments or you have questions. The presenters will look at that. I will be monitoring it to see if we can incorporate your comments or questions as we go along. We will reserve some time at the end for you all to ask questions or make comments if you'd like. If you have resources that you think would be helpful as we're talking about these issues, you can put links in the chat as well. This is being recorded and we will be posting it probably after this weekend to the materials page. And if you have not seen the materials, all the slide decks are in the email that we sent out to you with the Zoom link. You can go to that page. It's not a public page yet, but you'll be able to see whatever slide decks there are, and the video for this session will also be posted to that page. And then we'll add materials as the additional sessions come up so that everything is accessible to you all. So this first panel is first setting up the survey, what we did over the last year to learn about state practices and what is still ongoing. And then we're also going to be discussing a topic of issues which are really threshold issues to being able to participate in the tax system. Preparing your return, filing your return, and dealing with populations that are not normally integrated into a tax system because they may have so low income that they're not really part of the system. And as we go along with this 4-part workshop series, the next workshop series will be on audits, appeals, and adjudication, the 3 A's. And then the 3rd workshop series will be on collection, and there we'll be looking at both collection enforcement practices and then collection alternatives. What is the power of the state to collect tax, and how does it go about doing that? And then when does the state actually, in a way, accommodate taxpayers who don't have the ability to pay in full? And the final workshop in this series will be on taxpayer advocates and ombudsmen at the state level, and taxpayer bills of rights or charters at the state level, as well as state funding of low-income taxpayer clinics to get representation of low-income taxpayers at the state level, which the federal funding of the clinics doesn't allow unless the state tax controversy originates from the federal dispute, and sometimes that just doesn't happen. So I'm going to just turn it over. We've got a great group of people. I'm going to introduce them as they go along, but our first speaker is Anna Gooch, who is the American Bar Association Public Service Fellow at the Center. And Anna has been I would call her the mother of the survey. She has been monitoring, convincing volunteers to prepare it and fill it out and coordinating the information. And so Anna, I will turn it over to you.
Thank you. I will share my screen. All right, let's see. All right, does that look okay?
Yep.
Okay, great. So as Nina mentioned, the Rockefeller Foundation has funded this survey. And before I get too far into it, I just want to thank Nina for, like she said, giving me this project and letting me run with it. It's been really great, and I'm so excited to share it with you. So I'll get into a little bit more detail of why we think this survey was necessary. But generally speaking, we wanted to know what's going on in each of the states, in DC, in Puerto Rico, how the state administration of taxation affects taxpayer rights. So that's sort of the broad purpose. So in addition to just collecting the data and having all of it in one place, we wanted to be able to identify practices that are protecting or strengthening taxpayer rights, as well as practices that would benefit from change. And as we go along, we're identifying those best practices, and then we can turn the legislation that created that into model legislation for things like state taxpayer advocate offices, state funding of low-income taxpayer clinics, which Nina touched on. So the survey itself, and I will show examples of some of the questions that we're asking on the next slide, but it's very long, it's very thorough. I know some of our volunteers are on this call, so they know. In total, it's about 200 questions. We ask about income tax, if that state has one, sales tax, if the state has one, property tax, and then we also give space where our volunteers can say, in addition to these taxes, we also have a statewide alcohol tax or a statewide tobacco tax or any other tax that affects taxpayers statewide. Our volunteers came from the American Bar Association, various committees, as well as low-income taxpayer clinic practitioners, law firm, people who work at big law firms, small firms, anyone. It's a very broad volunteer base, and we're so grateful for them. The questions are, within each tax, they're divided into categories that sort of loosely follow the taxpayer roadmap created by Nina in her office a few years ago. So return filing, return processing, assessment, audit, and so on. And we'll touch on these categories throughout this workshop series, which again loosely follows the taxpayer roadmap. So going back to the purpose, to get into a little bit more detail, we know that many states, unlike the federal government, have balanced budget requirements. So the state cannot spend any more than what it gets in revenue. So how does that requirement, how does that need for revenue impact taxpayer rights? We also know that there are limited opportunities for pro bono representation. Again, many states do not fund low-income taxpayer clinics, and so even in states where there may be several clinics that help taxpayers on the federal level, there isn't that equivalent for state tax issues. Finally, there aren't as many avenues for systemic advocacy. So we know the clinics are doing a lot of that at the federal level, but again, there's no funding in many states for state issues. At the federal level, there are also there are advisory committees, there are boards, there are organizations, and I use that term loosely, that are sort of overseeing federal tax administration. And we just don't know what that looks like at the state level, which is another reason for the survey. So those are just high level why we're doing the survey. And with that, here is just a sampling of questions from the survey. Like I said, it's about 200 questions, so I wasn't gonna give you the whole thing here, but just so you can get an idea of what we're looking for. We are looking for procedural administrative information. We're not really looking at substantive information. So on the top in blue, these are some example questions from the income portion, the assessment section. So what does assessment look like in your state? How long does the state have to assess a tax? What kind of authority does the state have? Do they have jeopardy assessments? Do they have termination assessments? Questions like that. Here's a sample in orange from the sales tax section within the appeals category. So how do appeals of sales tax assessments work in your state? Do taxpayers have to pay the tax before appealing? How long do taxpayers have to appeal? And then finally, in green at the bottom, this is a section from the property tax portion of the survey, looking at collection of property tax. So how does that work? Does the state use private debt collection agencies? What kinds of licenses, if any, can be suspended for non-payment of property tax? And many of the questions do look the same across each of the three major portions. And we are seeing, oftentimes the state has the same procedures across different types of tax, but sometimes it's drastically different, especially in the property tax context, where usually it's not the state sort of administering the property tax law, but it's localities, so states, or counties, cities, school districts, etc. But this is just to give you an idea of what we're looking at. So throughout this workshop series, as we move through the different sort of components of state tax administration, I will be highlighting some preliminary results. So we have not received data back from every state, but I will just provide you with some relevant to that workshop information from the states that have returned the survey to us. So today we're talking about tax return preparation, tax return filing. And so here are some very high level results that we're seeing so far. So many states do regulate commercial return preparers, some a lot more than others. And I'll talk a little bit about that later on. All of the states for which we have received results offer a free e-file option. In some states, that's the free file program. Other states have their own system that taxpayers can use for free. Sometimes it's income restricted. Sometimes it's available in Spanish and English or other languages. Sometimes it's not. So even within this category, there are variations, and we're able to track that. Almost all of the states offer an earned income credit. Usually it is close or connected to the federal earned income credit, and we'll hear about some of those later on in this workshop. A quarter of the states that we've received results for offer return forms, so forms connected to returns in languages other than English. So we can think about what that means when we're looking at populations where English is not the first language. And something that I thought was really interesting is return processing times vary dramatically, especially, we know this at the federal level. Paper returns, amended returns take a lot longer than e-filed returns, but even at the state level, e-filed returns, some states that we've seen results for are reporting, within a couple days, less than a week, your e-filed return will be processed. Some states are saying up to 8 weeks for an e-filed return. So it's something to keep track of, and something that I'm noting as I go along. So broadly speaking, and this is not necessarily connected to return filing or processing, even though we haven't seen all state results yet, there are some things that I'm seeing as I get the results in that I would like to share with you all. Almost every state has a taxpayer bill of rights, which is great. In many states, the state taxpayer bill of rights is identical to the federal taxpayer bill of rights. But what does that mean? If every state has a taxpayer bill of rights, does that mean, are taxpayer rights protected in the same way? And that's something, we can't see yet. We're going to have to look into that more. Something that I have seen as I complete some of the surveys myself, I live in Pennsylvania. I'm completing the Pennsylvania survey. I am an attorney I think I speak English pretty well. And this information, when available, is so difficult to digest or to find in the first place. So that's something that, across the board, whether you're talking about audits or collection, it doesn't matter. The information can be difficult to find in the first place, let alone understand and then act upon if you're a taxpayer in that situation. And then to sort of leave on a high note, improvements are happening. So I've been working on this for a little bit over a year, and even within that short period of time, a year is nothing in the tax world. I've seen change. We have been, we've seen new taxpayer advocates offices. We have seen new appeals offices, and I think change is still happening, and from what I've seen so far, it's positive change for taxpayer rights, which is really encouraging. So this is sort of the beginning, but even now, I think that this work is really important, and hopefully we'll continue to see positive change as we continue to look into state tax administration. So that's the survey generally. Please feel free to ask any questions. Before I turn it back over to Nina, I'm going to touch on return preparer regulations. This is just a high-level overview. And I just two sort of statements before I get into detail. The first is that many states do, quote unquote, regulate return preparers. But in many states, that means that the preparer needs a PTIN with the IRS and that they're in good standing. So I didn't really include those in this chart because there's nothing additional to that. And the second thing is that this is very high level. There is more detail that I just don't have time to get into here. So if I gloss over anything, that's why. So there are 4 states that really regulate preparers pretty heavily compared to the other states. So all states, as you can see here, have an application fee. You have to renew it every year. Some require a little bit more than others. A couple states have an exam, and almost all of them have either a qualifying education requirement. So similar to the CPA exam, you have to have a certain number of credits before you're even eligible to become a return preparer. Other states have continuing education requirements. 2 things I'd like to note. So in New York, you'll see here I made this sort of footnote here that the requirements depend on the type of preparer. And in New York, the type of preparer, it seems like the law is trying to distinguish between people who sort of prepare returns on the side. It's not really their main source of income. If you are in the business of preparing returns and that is what you do, there are sort of higher standards for preparing returns. So they're really trying to distinguish between those commercial return preparers and then just sort of other people who happen to prepare returns. They also do have varying requirements, or heightened requirements for people who are involved in, I believe they use the term facilitate, refund anticipation loans and refund anticipation checks. So if the preparer is sort of offering that service while preparing returns, there are heightened standards for that type of preparer. Oregon similarly has different, oh, I'm sorry. I think I stopped sharing my screen. There we go. Oregon similarly has varying requirements there. It's similar to New York in that it seems like they're trying to really distinguish between commercial return preparers and other people. They distinguish between a preparer and a consultant. And you can look at the law and determine, what makes a preparer, what makes a consultant. But to me, it seems like the more involved you are, the heightened, the more restrictions or the more requirements you have to be licensed to do that in Oregon. So again, that's a very high level overview, but I just wanted to highlight before we get into the actual return preparation, that some states, we're already seeing differences in how states operate and what they require for those who are returning preparers, who are preparing returns. So with that, I will turn it over to Nina. And like I said, if you have any questions, feel free to throw them in the chat.
So thank you. Several years ago, when California and Oregon were the only ones that regulated return preparers at the state level. And in 2002, I had made the legislative recommendation in my annual report to Congress as National Taxpayer Advocate to have federal regulation of return preparers. And the IRS came back and said, no, we shouldn't do that. Let's leave it to the states, which of course made no sense for a federal income tax to be regulated at the state level. So you had 52 different regimes, like good thinking. But anyway, the Government Accountability Office went out and did a study, and they looked at the returns that were done in California and Oregon. And Oregon had a 2-level where if you wanted to prepare business returns, you had to have more education, more continuing education, take a different test to qualify than if you just wanted to prepare the 1040 series of returns, which I found very interesting. And they did find that unlike California's regime, where they just couldn't find, they didn't find a statistically significant difference in the quality or the accuracy of the returns, they did find that in Oregon. And Oregon also published the fines and penalties against preparers publicly. But that's probably 15 years ago, and it's really worth studying. Terry Oley noted that California, and I think in particular the bond requirement, might be a very high barrier. And do any of the survey, and Leslie was asking, do any of the survey results include participants from tribal entities? And we don't. And Leslie, I'd really like to talk with you about that later. And we're also working on bringing in Puerto Rico to get that perspective as well. So with that, we've sort of got, we led with regulation of return preparers, since these are folks preparing the returns. And now we'll move to Gabriel Zucker from Code for America, who's going to talk about actually trying to get people to be able to file returns in a simplified format. So Gabriel, you want to take it away?
Yes, thanks, Nina. I feel like going after Anna was covering like all of the things, and I'm going to cover something incredibly specific, which is what we work on here at Code for America in the tax portfolio, which is specifically people who can get refundable credits from the tax code, people who are disconnected from the tax system, usually very low income people, and how we can make sure that they can access state tax systems. I'll start just, I know I see a lot of familiar faces on this call, but I'll do a very quick background on who Code for America is, who what we call the tax benefits team is. Code for America overall, we're a nonprofit organization that partners with the government. I can read this slide to you. That partners with government to strengthen the delivery of public services through human-centered technology. So we believe in government services being accessible to everyone. And we primarily use technology to help make that happen, to make sure that people can access government in an easy, straightforward way. And we have a lot of different program areas, but specifically, I am part of what we call our tax benefits team. I think tax benefits isn't necessarily a term that everyone uses, especially if you're actually in tax administration, because you're administering a whole tax code. And there's obviously lots of aspects of that are outside the scope of what we look at. But we are coming at it from this really specific angle, which I'll ask everyone to keep in mind as I'm going through here, that we came at this from, well, it sure looks like a lot of our social supports in this country are coming through the tax code. And if you're not getting those refundable credits, that's the support that we as a society are offering to people in a lot of cases. But there's lots of people who aren't connected to the tax systems who aren't getting that support. And our goal, our North Star, as this slide puts it, is to close the tax benefits participation gap. So that is, everyone who's eligible for the earned income tax credit, for the child tax credit, for these other major supports for workers and families are able to get them. And so far that's been a lot of federal, but we really believe that at the state level as well, which is why I'm excited to be talking to all of you. I'm going to start by talking about some of our work to date, which has been pretty purely federal. And I think for those of you who know us, this is probably the work that you know us for, which is our work through Get CTC and Simplified Filing. And I promise, get to states in just a couple minutes. When I talk to a tax audience about these kinds of issues, I like to start not with like, here's our tool and what it looks like, but like, let's start with actual like tax law kind of stuff. At the beginning of the story about simplified filing in the last few years, starts in 2020 when Congress passed the CARES Act with the first economic impact payment, which was available to nearly everyone. Certainly, it was not a function of your income at low income, so you didn't need to be reporting your income to get this, but you needed to file a tax return. And just a few days later, the IRS issued this revenue procedure 2020-28 for people who weren't otherwise required to file federal income tax returns. And it was a set of instructions for how to file a 1040 without doing the hard parts. So it said, yeah, fill out your name and your address and your social and who your dependents are, because we don't know that, but you know that. That's not necessarily that hard for you, a person who knows who you live with. But skip all this income stuff. This isn't relevant. Skip all this, whatever, all the taxes and payments and whatnot. This isn't relevant. Tell us where you want the money and sign it, and then we'll send you an economic impact payment. That was the beginning, at least in the last few years, of what we are calling simplified filing. So how I like to define this is that simplified filing is a streamlined tax filing process. You're still filing taxes, but it's saying you can skip some parts of this that might have been the tricky parts. It's for households without a filing obligation. So this has been in the last 3 years restricted to if you don't have to file a full federal return, you can do this alternate process. And the IRS is just requesting the data items that it really, really needs to issue the key benefits that are being issued through the tax code, not other stuff that might be interesting to have, useful to have, that might make you eligible for other credits, just these very, very basics for these credits you're trying to claim. And it was based on that revenue procedure, or more to the point, the reissue of it the following year, and now again this year, that we built what we call Get CTC, which is our user-friendly implementation of that simplified filing process that the IRS authorized. I hope many of you have seen this tool, so I'm not going to do a whole demo right now. I'm just going to highlight some of the things we saw when we ran this for 2.5 months last year. Excitingly, we've been running it for far more than that this year. So soon I'll be able to start using slides about this year's numbers rather than last year's numbers. But for now, I'm still on last year's numbers. We had Get CTC open from September 1st until November 15th last year. We had over 115,000 accepted returns, including once we really ramped up after the first 6 weeks of getting off the ground. It was nearly 3,000 a day. Nearly 4 out of 5 people told us they found this tool either easy or extremely easy to use, including people who had never filed taxes before. So we had people who said, like, I've never filed, and they filed an actual tax return with us, and they said, yep, that was easy, which is pretty cool, we think. The typical experience, you're looking here like a distribution of the amount of time it took to finish the tool. It typically took about 10 minutes, 3/4 finished in less than 15 minutes. 3/4 finished in less than 30 minutes, excuse me. I think it was about 4 and 5 are doing this on a mobile phone rather than on a computer. And we like to trumpet that we have chat assistants on every page, and we do, but less than 1% of people actually took us up on that chat assistance. Most people just went on through, didn't have any questions as they were finishing the simplified return. So the key takeaway I want to offer from this experience, aside from the fact that GetCTC is open right now through November 15th, and if you have folks who are eligible for the child tax credit or the recovery rebate credit, it's a great time to start sending people there right now as well. But the key takeaway for this purpose that I want to highlight is that, when you request less information, and especially less complex tax information, more low-income people can file. Kind of an obvious point, but I think we saw that pretty clearly from running this tool. Okay, so that's federal. That's what we've done so far. What am I doing talking to you all from states at this meeting? Well, obviously, this is incomplete until we can apply some of these lessons to states. We don't just want to file federal returns forever and then leave people hanging for their state filing obligations or their state credits or what have you. That's not how we see this. So we've spent a lot of time thinking about how we apply this to states. And what I want to suggest is that it's the lesson here isn't that we can create a similar tool for states per se. That's not necessarily what the goal is. That we take something that looks a lot like GetCTC and make it get Cali ITC or whatever it might be. The lesson is to request as little information as possible. Like the thing that we learned here was that when you request less information, it's easier to go ahead and file. And the thing that's interesting about state returns is that in this case, it's actually easier because we already have a federal tax return. Now, I know that's an assumption. We have some people who maybe haven't filed federally because maybe they have a state but not a federal obligation. Maybe you're now in a state that has a fully refundable credit, so you're going to have zero income people filing for state but not federal. I get there's caveats there, but we really are thinking about this in terms of, let's suppose people have filed federal returns. That is typically the front door to the system. And we want to see that continue to be the front door to the system to keep this as simple as possible. So go with me on this journey for assuming we have a federal return first, and then we can come back to the question later if people want to, why that's an assumption we're making. So I want to propose that what it means for states to do simplified filing, based on the same learnings we have from the federal experience. And this is the slide from before, but with some words changed in red. It's a streamlined tax filing process for households with simple tax situations, and I'll go into why in a second. And without a filing obligation, which the state tax agency, rather than the IRS, of course, is requesting only the data items that it absolutely needs and which cannot be gleaned from the federal return. So we're starting with the federal return. We've got people with simple situations. Simplified filing is for people with certain restricted cases. How little can we actually ask for? And still be able to get, have people fulfill their obligations and get whatever credits are waiting for them. The trick to this, as we've been thinking about it, and especially talking, I see some familiar faces on this call, we've talked to some of you about this and how it might play out, is to define a limited scope where this works. Now, the details of this are going to vary a tremendous amount based on the state law, based on I don't have access to the data that you all in tax departments do in terms of actually what cases are and are not common. So take this with a big old grain of salt. This is kind of illustrative, but something like a limited scope that one could define is, all right, we'll do W-2 income only. Maybe we can actually look at the data and decide what the next one or two sources are that are relevant. But let's say for now it's W-2 only. Standard deduction, people who are federally doing standard deduction, state one, aren't going to have some alternate deductions there. Full year residence, so we can get rid of the part year resident complexities for now. Dependents that are reported on the federal return. So if you have some kind of mismatch between state and federal dependents, let's look just at dependents that are showing up federally. A core list of just a few key refundable credits. So, lots of states, you have 200 credits, whatever it might be, but a lot of them aren't going to be relevant to low-income people who are struggling to interact with the tax system, who are really going to need a process like this. So you don't need the historic preservation for brownstones credit for a low-income person who doesn't own any property. People with no filing obligation, this is still our focus. This is for people outside the core tax system. I think one could look at loosening this in some cases, but this is really the core of what we look at. And then depending on your state law, I'm putting these here to be a little provocative, but in some cases, elderly taxpayers have a whole bunch of complexities because there's 7 different standard deductions based on some ages and some pensions. So maybe for an initial bite at the apple, you leave them out of this because you can keep it simpler. And maybe for some states, you have a EIDC that supports ITIN holders. And I, speaking personally, think that's great in terms of as an equity measure. But maybe for an initial process, because you want to keep this simpler off the bat, you look at SSN people only because there's less complications. These are being provocative intentionally. One could include these folks in the initial scope, but just trying to look at what it would really mean to simplify as much as possible. And then once you have this scope, hopefully what you have is a large fraction of low-income households who are struggling to interact with the tax system. But also because you have created the scope this way, you've actually obviated the need for most of the many long, potentially complex ins and outs of the state tax return. So in terms of what this can look like in a very stylized sense, this is like the list of things that are broadly speaking on your state tax return in most cases. Basic info, well, usually you can get that from the federal return. It's not, not like they need a different address or a different name or different date of birth or what have you. You've got additions to income, but if you're going to restrict to W-2 only, frequently none of these are going to be applicable. These are all specific types of income that if someone said, no, I only earn from W-2s, these won't come into play. Same with the subtractions. Obviously, this will depend very much on the details of the state, but if you're doing W-2 only, a lot of these little detail-y things that are for very esoteric types of income are going to be definitionally not relevant. Deductions and exemptions, this very much will depend on the state. From some states that we've looked at and talked to, you might need 1 or 2 additional questions about maybe a type of pension or something or whatnot that sometimes does play into deductions, but also in some cases, you're not going to need this. But you can try to get this down as much as possible. For credits, you pick the few ones that are going to be really relevant to this low-income marginalized population. I think in a lot of cases, that's the state EITC. In some cases, it's a state CTC. In some states, there's a homestead or property tax or a renter credit, something in this vein. For the state EITCs and CTCs, you can, I think in many cases, get the information you need from the federal return. It's just a fraction of the credit, or it's some function of the dependents, but those dependents are already reported. Usually for these kinds of credits, you might need some additional information like the rent or the property tax or what have you. But that's one question, not an entire return. Additional taxes, maybe use tax is relevant. That's the one I've seen come up in a couple cases, but I think generally the other taxes on the return are not going to be very relevant to this population. The payments from this population are already known. They're on W-2s and estimated tax. So that should be knowable already without asking the filer. And then there's like a little grab bag of other of like things from looking through a bunch of state tax returns that like maybe you don't know. Like you might need attestation that they're full year residents if that's the simplification you're making. You might need some like county codes and you need to like write like which county it is, and you can't infer that from the address maybe, or maybe you can. In some cases, there's specific documentation required for deceased taxpayers. I've seen out state but not federal returns. So maybe there's some complexity there. But if you add this all together, you started with a very big return. And then if you actually take very seriously limiting this scope and basing it on the federal return, you don't need very much. So here's a very, very high level dummy example. This is anyone from Colorado on the call? Colorado is one of the states I looked at early. So I had all the screenshots handy of the Colorado return. This is like a normal amount of pages I think a low income household might have to go through for the full Colorado return. But if you take this stuff seriously, you're down to this question about whether your EITC qualifying children are deceased, which is technically not asked on the federal return, but is on the state return, the use tax question, an attestation of full year residency, if you're going to try to get not get into the part year stuff, but then find a way to skip it. In Colorado specifically, you're looking at EITC for ITIN holders. You decide if that's in scope. And then you look at maybe this the PTC or top bar credits, which have a couple other wrinkles to them, but it's it's a question or two. So you start with all this and you end up down at a couple of things. Not picking on Colorado at all. This is just the one I happen to have, and I think it's a good example. But I think you could do much the same exercise with any state you happen to pick up. Just a couple last few slides here. One way to think about how to tackle this is to pilot it on paper. I think, do we have Illinois on the call? I'm going to brag on your behalf for a second here. Illinois did a very cool project where they started with prior year federal only filers, hadn't done the state credit yet, but who looked EITC eligible, and then sent an examiner's report, which is basically like what would have been the substitute for return bill process, but then it was actually for a refund instead of a bill, and sent that out to folks. And they just had to confirm a couple things and claim the credit. This is a kind of similar process that we're talking about here. It's saying, well, we have a federal return, we know a lot from it. We're just going to work with the lawyers and figure out just the things we really, really need to confirm, and then send out a piece of paper confirming those things. And that way you get to work out, here's our piece of paper. What questions can we fit on it? What can we find a way to not, who can we not include in scope so that we can not include that question? And how do we make this really simple process? Here's the write-up I'm aware of from Illinois, but if someone from Illinois has another link, you should drop that in the chat. This is just the one I knew of. Another way, that's on paper kind of as a pilot, the way this might work electronically is, how does this actually play out? Well, one thing you could do is set up a partnership with a federal return preparer and get those federal returns via data sharing agreement with the client's consent. And then that's your federal return you start from. Another way to look at this is to have the preparer file kind of a dummy state return through MEF. So it's, kind of just some basics, some name, social, whatever. And then because it's a state return through MEF, whatever that can be slimmed down to, now you can access the federal return through MEF as well and start this process. I'm sure there's many other ways to look at this too. These are just a couple that have come up in some conversations, just food for thought. And I will close by throwing my email up here and say we are interested in helping states who want to explore this and see what we can learn from it. And please, if I haven't already spoken to you, please feel free to write and we'll talk more. This is, I mainly just wanted to share this kind of our way of thinking about the state filing question in the context of what we learned from federal simplified filing. And thanks, Nina, for the opportunity to share this.
So Gabriel, thank you on that. We have a question from Melanie, which is, would pilots involve forms in more than one language?
I think it's up to whoever is doing the pilot. One thing I do, like to push, we push this idea of a minimum viable product, from the tech space, that you start with the smallest thing you can do that works. And the reason is because doing things is hard. So you do the least possible things to prove you can do it. And then once you know you can do it, you add things. So I could certainly imagine a state arguing that their minimum viable product would be English forms. And then once we know that works, they add Spanish and Arabic and Chinese and Bengali and whatever languages are relevant to the state. Or you could argue that multiple languages is in the MVP. It's not, I think that would be really a state-by-state decision, and looking at the population you're trying to reach and seeing how much you could learn by doing the minimum amount possible to get started.
Yeah, the other thing that, and I'll say this to Anna, you're watching us in action here, adding another question that we need to follow up on, but what states have a data sharing agreement with the IRS that either allows them to get the information that a taxpayer has filed a federal return, a simple yes, no answer to that, so they could better target, the population that they may need to reach out to. And also, what states have more of a sharing agreement where they can get IRS data, the W-2 data, et cetera, or 1099 data from the IRS. I think very few. Leo asked, how would you address concerns about simplified returns opens up to fraudulent filings? I think that's something that everybody's dealing with any electronic return. You're going to have some kind of authentication.
Yeah, I mean, it's a very good question. And like, we are literally currently offering an e-file service. And like, what I do every 2 hours, and I'll do after I get off this call, is go look at our metrics to see if we're seeing any fraud that hadn't been aware of and weren't catching. So it's certainly top of mind. I'm not trying to dismiss its real issue. We have been experimenting with different tactics for screening fraud. We've been talking to different vendors with different tactics for screening fraud. I think there are ways to, I don't want to go into too much detail because I don't know, it's kind of technical stuff, and I feel like a lot of the point of these rules is that they're like kept kind of secret. I'd be happy to have a follow-up conversation, but I think there are ways to be screening out high risk returns without requiring absolutely everyone to provide all kinds of information you don't need. And to the degree that we're requiring W-2s and whatnot because we just want authentication, well, let's go straight to the source and solve the authentication problem. Let's not require a thing we don't technically need just because we're trying to solve a different problem. So sure, maybe W-2 is one of the ways we allow people to authenticate if we actually think that's a secure thing to do and a thing people want. But I bet if we're going to require authentication of some people, they're going to prefer some other options that aren't just the W-2s. So you definitely have to address it. It definitely has to be addressed in a way that is responsive to the needs of low-income people. And I think it's something that can be addressed. It's like a kind of classic technical problem. You work through it over time. You'd find fallbacks. You do in-person authentication. You try out different systems, and eventually you're finding a way to catch most of the fraud, while allowing through people who are bona fide people and have a lot of barriers to access the system.
Right, and one of the things that the center's working on with Code for America and another researcher at Georgetown is to really try to assess the impact on low-income taxpayers, these below filing threshold taxpayers, of requiring them to provide W-2 information. And so, people may be the legitimate taxpayer, but if you make supplying a W-2, the W-2 information a criteria for filing, you may be preventing legitimate taxpayers from being able to receive the benefits that they're actually eligible for. So, you've got to do a balance there. Well, thank you. So we'll move on to that to, I think it's Elena Fowlkes from the DC Office of Tax and Revenue, who will talk about some of these issues in the context of an actual tax administration. And Elena will then hand it over to Elissa Borges, who is with Counsel with the DC, and then Elena will come back.
Thank you. So good afternoon. It's always great to be able to participate in these workshops. So again, my name is Elena Fowlkes. I'm the Assistant Director of Operations at the DC Office of Tax and Revenue, and I'm here today with Elissa Borges, who is Assistant General Counsel, and we're gonna tag team on this presentation to talk a little bit about how DC is trying to reimagine state tax administration and how we're trying to do our part in order to make sure that our system is, fair and just and transparent and not leaving anyone behind. So in order to just kind of start us off, I wanted to provide a little bit of context about just DC as a taxing jurisdiction. It's definitely a unique place to administer taxes, and not just because it's the nation's capital, but also because we're not considered a state. And so maybe one day we can become the 51st state, but until then, there's some quirks just by virtue of it not having the status of a state that are relevant to today's discussion. And as we're talking about all the states having these different systems and different contexts, DC is definitely one of those. And understanding the ways that each jurisdiction is different will definitely help those practitioners that are working on these state level issues and in trying to find state level solutions to come up with something that works. So in DC, we've got the Home Rule Act, and the Home Rule Act is a piece of federal legislation that really puts a lot of limitations on who we can tax. And that means that while the district has the same fiscal obligations as all the rest of the states, it really lacks the tax base because we are the only jurisdiction in the US that is barred by federal law from taxing commuters or non-residents. And so I did see recently a statistic that said that at one point, almost 70% of the people who work in DC don't pay district taxes. And in addition to that, we also function as both a state and a local jurisdiction. So we administer all of the income taxes and taxes that any other state can administer, but we also administer real property taxes. However, because we're the District of Columbia, we have government offices, we've got the seat of the federal government, we've got the foreign embassies, and all of those are tax exempt. So as we're talking about, ways to reimagine tax administration and having these creative ideas and projects that we can come up with, we also have to remember that within that context, we have a really limited source of revenue. So as we're coming up with these ideas, we also have these limitations as to how we can pay for them. And part of that really does come from that balanced budget requirement as well. So even though DC is usually at the top of the list for income inequality, which just means that there's a huge difference between the top income levels and the bottom income levels, we're really trying to balance the challenge between, addressing the needs of those at those bottom income levels and the people who really desperately need these refundable credits and other benefits, to also the fact that we, have to come up with the money from somewhere, and we can't spend more than we're bringing in. So it's kind of within this context that I just want to talk about, how we're working in DC to advocate for these improvements to our policies, our processes, and our systems, and then what we're doing to try to reimagine how we're approaching the tax system as a whole. So I'm going to hand it over to Elissa Borges, and she can start us off by talking about what we're doing with regard to the refundable credits in the district and how we're trying to reimagine the administration of those credits.
Thanks, Elena. So I wanted to talk a little bit about the DC earned income tax credit, because there have been some significant changes in the recent legislation passed by the council as to how that benefit will be. And on this, just a little bit of background. The district has historically had a DC EITC that was, for the most part, there were three categories of taxpayers who could claim it, and these should all be somewhat familiar concepts to most of the folks on this call. Taxpayers with qualifying children, taxpayers without qualifying children, and also non-custodial parent taxpayers, and we call them Schedule N filers in DC. But for the vast majority of with the exception of last year, of the taxpayers who are claiming the EITC were taxpayers with qualifying children. And for the most part, it was a pretty straightforward calculation that if they claimed a federal EITC, they got their DC EITC was 40%. That was also true for non-custodial parents, but they had to prove some other things that that they paid child support and some other things in order to qualify for that. And taxpayers without qualifying children also had to file a federal return and claim it. They essentially got 100% of their federal EITC for their DC EITC, but there are some nuances for how that would be phased in, and it was generally more generous than the federal. So, and obviously those refunds got paid out. A tax return would get filed. They got paid out in the ordinary course. Maybe it took a few days or a few months to pay them out, depending on the particular thing, but it sort of got paid in the normal issue, in the normal way. Well, in 2021, the council had sort of a radical change to how they want to administer OTR to administer DC's EITC. First, what they want to do, they have instituted that the earned income tax credit is going to change for taxpayers with qualifying children, and then also for non-custodial parents as well. So that it's going to, by tax year 2026, it's going to be 100% of what the federal EITC is. There are a few years where there is a phase in, and that was purely really for budgeting. So, you know, how they would sort of forecast that and come up, but it's going to go, so for the current tax year we're in, it's at 70%, and it's that way for then 2 years thereafter, it goes to 85 and then 100. Okay, that's more generous. That's great. But here where there is a sea change in how that's going to be is that the policy goals of the council was they wanted to sort of start you know, a pilot program or phasing in basically a universal, but not quite universal here, basic income, where the earned income tax credit will no longer be paid out as usual in sort of a lump sum when a tax return is filed through the filing season. What it will be is that the earned income tax credit portion is going to be paid out in equal monthly installments. So taxpayers are not going to get one big check, they're going to get 12 little checks over the year. And the policy goal behind that, as communicated by the council, was that ultimately is found to be a better tool for fighting poverty. Not my expertise, there were other people who testified on behalf of that. So however, for tax year 2022, so next year's filing season though, they didn't want to, there's probably some taxpayers who have an expectation that they're used to getting a significant check when they file. And they didn't want to sort of surprise them with, hey, you know, you've got this big refund, but you're only going to get 1/12 of it, you know, and that credit card bill, that whatever you needed to pay off. So there's a transition year that makes my head hurt when I go through it and we talk to how they're going to program this in the computer. But basically, the goal is that people will get in a lump sum upfront as usual what they would have gotten the previous year, all things being equal. So that basically they will get a lump sum of what 40% of their federal EITC was, and then the remainder will be paid out over 11 months. So in theory, people should get their same monthly, you know, their same lump sum when they file their tax return in filing season 2023, and then they'll get and then the rest is going to be doled out in monthly payments. But then starting next year, it's going to be monthly. So if you have a taxpayer is consistent, they'll get their normal refund as usual. And then till the end of time, they're going to get, and assuming they file every year and their income is relatively the same, they're going to get a monthly check forever. Okay, till they do it. As you can imagine, that like presents a lot of challenges for how OTR is going to administer that. One is there's a cutoff, you know, at some point it doesn't make sense to divide up a relatively small refund into monthly payments. So if there are thresholds that they're below, that's going to be paid out, the taxpayer will continue to get that in a lump sum. So $600 for tax year 2022 and $1,200 going forward on that. Also, there are challenges is that, you know, for a lot of taxpayers, they will file a tax return, they'll get their refundable credit, and that's fine. But there are taxpayers, as you know, who actually do have a tax liability, and how does that factor into it? They're going to be taxpayers who have had withholding, and they'll continue to get that upfront. But if they have a liability, what gets applied first? There might be offsets with debts from previous tax years or future tax years that come apart during the payment plan, and there's also federal offsets. So all of those are going to sort of add a level of complexity to how this is going to how this is going to play out. And also, as you know, OTR, and I'm sure every other tax administration, sometimes it can be a challenge to get out one payment to a taxpayer. That taxpayers have the option for a direct deposit, paper check, or in DC, something called a Relia card, which is the contract, there's a fee for it, but a debit card that taxpayers, if they wanted to, could receive their refund through a Relia card. But that never goes smoothly. People move, they don't put the right account number. So there are problems sometimes getting one payment already. And now we're going to have to send them 12. And this particular lower income population are not as banked as other taxpayers. They're a little more transitory. They might move throughout the year if they've opted for a paper check. Again, that presents yet another challenge. I did mention the Relia card, which is the debit card. OTR is working with the vendor, so that this is probably a good thing, that if a taxpayer is their address is going to be a little transitory, and maybe mailing out a check every month is not helpful to them, and they don't have a bank account. OTR will be able, if they opt for the Relia card option, to refund those every month. So it's not exactly the same, but I imagine it's somewhat similar to how a SNAP card would work, with like benefits that get applied to that. So we're doing that. So that's what we've been working on. But another change, and that happened just recently in this year's budget, the council then said, we would also like to expand the population of eligible people for the DC earned income tax credit to residents without social security numbers, who would include undocumented folks. And as you may know, those people who do not have a social security number, typically, again, undocumented folks, are not eligible for the federal EITC, but starting for tax year 2023, they are going to be eligible. So they're going to be a couple of challenges as well, because remember, these are people who will not have claimed the federal EITC, and sort of figured out whether, all right, am I within the income, thresholds and all those other things. And also, and they may not have filed a federal return at all. So that's going to be a little bit difficult to do that. Plus OTR, what is going to have a little bit of issue is for the undocumented folks. That's not an issue that they're not a permanent resident or citizen of the United States, but how do we are going to be able to verify that they actually are a DC resident? That in terms of they're eligible from a fraud perspective, that we don't have people from out of state claiming that they are DC residents for the purposes of claiming that. So I just wanted to highlight all these for you. We are working through all the issues. It's going to be an interesting tax filing season for how this goes. And with that, I can point out the problems, and then back to Elena, because she's the one who has to come up with all the solutions.
Thank you. So Elissa, if you could go to the next slide. So, one really important tool that I just wanted to share within the context of this discussion that allows us to better administer all of these changes, including the newly expanded EITC, is going to be our My Tax portal. So what you see on the screen is that landing page where people can access this online application by just going to www.mytax.dc.gov. And this is available both on the computer as well as somebody's smartphone. So DC is like a lot of other jurisdictions across the United States, where we're using this powerful software that allows us to be able to provide solutions to taxpayers, and it also gives them a lot of options as well. So some of the things that people can do on this is that they can either log in using username and password, which allows them to access a lot of account specific information. They can see tax returns that they filed. They can view letters that we've mailed them. They can set up automated payment plans, Or we also have a number of non-login options, meaning that they just ignore that username and password bubble and scroll down on the screen. And that allows them to access a lot of the options that really aren't associated with somebody's account. They can submit voluntary disclosure agreements. They can ask for help with a problem from the Office of the Taxpayer Advocate, and they can also access a lot of their real property tax resources and options as well. And so part of it, what we were trying to do here is to make sure that people just had a ton of self-service options. They can log in at 3 o'clock in the morning. They don't have to wait on hold. They don't have to pay for transportation or parking in order to come to our office in order to deal with something face-to-face. And the idea was, we really wanted people to have, all of these options at their fingertips in order to be able to complete these routine tasks on their own. So Elissa, if you could go to the next slide. Another thing that we're really excited about to be able to introduce to the public is that as part of our My Tax and online web application features, people can file their online individual income tax return for free using the portal. And so, as you know, as everyone on this call knows, there's a financial and an administrative burden in just return preparation. And what we didn't want people to do is to be in the position of, not wanting to spend the money to get it prepared in order to get a credit. And so we tried to brainstorm different ways and things that we could do to try to, reduce that administrative burden for them. And being able to offer the D40 return online was really something that we thought would help on that with regard to reducing that burden. And also, although we were really excited to be able to roll out the electronic form, and we really did believe that it would be well received, I just want to point out that the creation of the form, and this is similar to the changes that are coming up with the earned income tax credit, that's just the beginning of the process. So, we have this idea, we create this process, and then we find ourselves in the position of having a lot of things that we're trying to balance. So, we're trying to issue the credits out quickly and correctly, but at the same time, we have a responsibility to our taxpayers to try to safeguard funds and to prevent fraud. And so trying to make it as easy as possible with the least number of obstacles is a huge priority for us, but also we have to put some obstacles to prevent people from being able to erroneously claim or to be able to fraudulently file requests for these refunds as well. And in addition to that, there's going to be other obstacles that we are trying to work through, such as, once we started working through this process, we identified the fact that, why is this application not available in Spanish? Why don't we have additional language options where people can see the form in the language of their choice? And so right now we're working through some of those options and what that would look like and whether or not that we have the technical capability to be able to do that in a way that that makes sense. And then we one of the issues is that some of our internal folks had mentioned, like, well, if someone files a Spanish return, we don't speak Spanish, so how can we know what they're filing? So just making sure that there is a way to have the taxpayer see it in a language that they understand, but then have the data transmitted on our end in a way that we can process it without any issues or without any hiccups. And then also, there's a large volume of other information that we had to update to make sure that everybody, had the information that they needed to be able to understand the process. And that included updating our website, updating the hold message information when somebody calls in and waits on hold. We wanted to also hire a new group of individuals within our administration so that they could specifically be trained to handle the EITC escalations. But as anyone on the call knows that works with government, it takes some time to hire and train and create positions and make sure that everybody is in place and ready to go in time to be able to do the things that they're trying to do. And also having an electronic system where taxpayers can interact with us digitally opens up a world of possibilities, such as maybe exploring the idea of pre-populated returns or providing tailored and customized digital experiences for our taxpayers. However, there's also some pitfalls. And so as we're trying to encourage people to sign up for the online portal and to utilize these online options, there's always going to be a number of people that just don't want to use them. Either they're not digital, they don't like the digital options, or they aren't tech savvy. Maybe they don't have a computer or don't have access to the internet. And there's also people that we found that just like to talk to somebody, face to face, or, talk to a real human on the phone. And so we're trying to be sensitive to the fact that, we don't want to leave people behind. So as we have a ton of these online options and we feel like they're easier to use and they're more streamlined and they're faster and they're more secure, we also don't want to make it to create a situation where people are going to not have any other options if they're unable to take advantage of those digital interfaces. And so just as a quick example of one of the things that we discovered is that individuals have the option to go through My Tax and submit a request for assistance with the Office of the Taxpayer Advocate in DC. And we thought the process was super straightforward. You go online, you enter your personal information so that we can contact you. You just provide a brief description of your problem and you can upload supporting documentation if you have any. And then you submit the request and it's automatically assigned to a staff member within the Office of the Taxpayer Advocate so that a specialist can work the case, and it's stored electronically in this super manageable queue. And so when we went in, as we periodically do, to just capture feedback related to how people are ranking the process and how people view the difficulty of the process to be, we can also see some comments that they made. And one of the things that we thought was really interesting is that people said that they were annoyed that there wasn't a phone number on this online process. And the whole reason that we established the online system was to avoid having these calls and escalations, and to try to funnel people through this digital process so that it would be faster and easier and more secure. However, this really did bring up the prospect of one of the challenges being public trust. So by the time people got to this online escalation form, they'd already tried to work through a problem. They already, were frustrated and annoyed with the process. And so one of the things that we're really mindful of at this point as we're trying to work out these online solutions is that people have to trust that the process is going to work in order for them to be willing to take advantage of these online solutions. And so public trust really does end up being a huge aspect of this. And so if they don't trust that they're going to get a response, maybe they've already submitted a couple of online requests to other departments and they didn't get the call back that they expected, they don't want to submit another online form. So, we're working through this process, trying to make sure that the solutions are simple and straightforward and intuitive, but also that people trust that the process is secure and safe and effective in order for them to be able to, take part of this process and to utilize these options. And the hope is that, while we understand that there are individuals who are not going to be able or really are unwilling to access these digital options, at the same time, the more people that are able and are willing to use them, then, that leaves additional resources and staff available to answer the questions for the people that will still have to service face to face. So, really our commitment is going to be to make sure that we have a fair and transparent and effective process, not just that people can use, but that people can trust. And so, and that'll enable us to be able to utilize some of these technology tools and to be more innovative as we move forward. So Elissa, if you could go forward one screen, I did just also want to share our contact information. So if anybody has any additional questions or comments or ideas, you're welcome to contact either one of us. And I'm happy to take any questions or comments as well if anybody has any follow-up questions.
Elena, that's a really fascinating discussion, both for you and Elissa. And as a resident of DC, I will be watching very carefully and closely to see how this rolls out. Your thing about the phones reminds me, one year the IRS did a study of collection letters, and they what they did was they sent out notices with different messages to see what people's messages, what people responded. They did not put a phone number on those collection notices. They were trying to drive people to the online installment agreement app that people could just divide by a certain number and enter into an installment agreement. And they sort of celebrated the superficial data, which was these were how many online installment agreements were compiled. But as they delved deeper, they were able to see that even though they gave no phone number for the collection people, the folks that received these notices found their way to the phones, and they ended up calling about 3 different other IRS toll-free numbers, including the taxpayer advocate, just to be able to talk to someone. So, you know, what you did was you increased people's frustration and their distrust by not putting a number on the notice, you know, and making them go through a whole rigmarole. I thought that was really an interesting sort of, you know, Machiavellian study or something. It sort of backfired a little bit. So now we're going to go to Dana Goldstein, who's with the Community Legal Aid in Akron, Ohio. And she's going to talk about an experience and a lawsuit that she brought, and some weird provisions under Ohio law that sort of raise some issues that that are, I hope are unique to Ohio, but this is a little bit of systemic advocacy and action as it unfurls as it's going along. So Dana, you want to talk about your experience and your issue?
Sure. Let's see. So I was tasked to talk about the Ohio litigation that tried to tackle double taxation. The problem of double taxation, of course, arises with the filing and the processing of the state return, which is why I think we were slated for this presentation. I think we aren't alone in these problems. I think there are other jurisdictions, other states, hopefully not many, that have similar problems to Ohio. But anyway, first I will address the problems that we have. I will discuss a little bit about why taxpayers don't have W-2 documents, how double taxation actually happens in Ohio, the filing process that our relators used in our action, the mandamus that we filed, admittedly a long shot, and the positive outcomes that we did achieve, as well as our current posture. So the problem, taxpayers who don't have a W-2 when they file their state tax return obviously don't have an amount to insert for the state income tax withholding. The state of Ohio processes the employee's tax return as if 0 state income tax was withheld, even though income tax was withheld by the employers and sent to the state as required by statute. The statute requires employees to only report the amount of their dependents, and they require the employers to immediately withhold, basically on $1. So when taxpayers who do not have their W-2 information contact the state of Ohio, the taxpayers receive 2 responses from the state of Ohio. The first response is 1, we don't have that information, and 2, put 0 for the amount withheld on the box for withholding, and you can appeal later. The continued problem is that it is procedurally impossible to prevail in an appeal of an assessment to the Board of Tax Appeals because the burden of proof is on the taxpayer. The taxpayer doesn't have the information of how much was withheld. The state won't provide it. You can't meet the burden of proof. And there have been several cases brought to the Board of the Tax Appeals with this precise problem, where the taxpayer has implored the state, please just tell me how much was withheld and paid to the state. And the state responds no, and the taxpayer loses. So the next question is, what? The state doesn't have that information? And I have to report that this was true. The state of Ohio only required employers with 250 or more employees to file the individual W-2 information with the state of Ohio. Employers with less than 250 employees were exempt from this provision and never were required to file the W-2 information. The state of Ohio said that these employers, of course, had to maintain that information in case there was any audit. What the state required is that these employers file an IT3, which is an reports in aggregate to the state of Ohio the amount of wages paid to the employees and the amount of withholding, all in aggregate. And I am assuming then that the state of Ohio ran diagnostics on this IT3 to see whether or not the employers were generally in compliance. So why do taxpayers not have a W-2 information? And for those of us who serve the low-income taxpayer community, we see this all the time. There, of course, are the housing challenged, those people who move from place to place within a year and their W-2s never catch up with them in the mail. There are a lot of our taxpayers, our clients, in fact, work various jobs. Most of them, I would say, in fact, work for more than one employer during a year. And while they may have one W-2, they don't have all of the W-2s. And for our relators, Palm, he was a non-filer for 16 through 18. He wanted to become filing compliant. He contacted one of his employers and that employer was no longer in business. Simply couldn't obtain the W-2 information. The other relator in our mandamus action, Pearson, was a survivor of domestic violence. And guess what? When she left the house to escape domestic violence, she did not think to grab her W-2 on the way out the door. Later, her estranged, now ex-husband, had a small bonfire and set all of her belongings on fire, including the W-2 information. So she also didn't have W-2s. We know that the state's bookkeeping is inaccurate because they weren't requiring employers with less than 250 employees to even file the W-2 information with the state of Ohio, which quite honestly boggles my mind. But how does this double taxation happen? And I just have this just briefly as background. The state income tax system works really pretty analogous and parallel to the federal. Employers are required to, by state law, to withhold state income tax from employee wages. On the flip side, employees are required to claim only the entitled exemptions. There is no opt-out provision. So for example, in the federal system, you can potentially claim more exemptions so that you don't have much withholding, especially if you're intending to get the earned income tax credit. But on the form IT4, which is a state form, and under state law, you, the employee, are only eligible to report the exact dependents that you have living in your household. Failure to do so is a violation of the law. Employers are then required to send the income tax withheld from the employee's wages to the state. And the employees are taxed on $1. So we know that there is income tax withheld from the employee's wages. And to echo what Anna said, when I was researching all this Ohio law, because we are the LITC and we resolve primarily federal controversies and sometimes state controversies on the side, it was very difficult to research and find out all this Ohio law. And it is complicated, it's dense, and it's hard to figure out. So the other problem is the software, and TaxSlayer, which is used by VITA, prepares input the information, for example, using wage and income transcripts obtained by the federal government. These federal transcripts, of course, have the amount of federal withholding, but they do not have the amount for state withholding. When a federal return is filed using TaxSlayer, and I think most of the software that is used in Ohio, I haven't double checked that, then a bogus W-2 is created with zero withheld for state, just as a state requires you to do. A state return is then filed with zero withheld as a state mandates. And the problem is that a lot of taxpayers don't even know that this is happening. They go to a VITA site, they're happy as a lark, really, because they have filed a federal return. They get the EITC, a federal refundable credit. They get the CTC, the federal refundable portion of the CTC. They get their withholding for the amounts that they over withheld, and they get a sizable refund. They frequently don't get any state refund, but they don't owe any money either, even when a zero amount is put in for the amount withheld. They don't even know that there's money on the table being collected by the state, which should be returned to the taxpayer. It's the taxpayer's money, after all. So we get into the reverse Robin Hood. How does that happen? I think I've already sort of set this out. 1, taxpayers file state returns. 2, the software defaults to 0 if there's no withholding information. 3, we know the state requires withholding. So if there is withholding for federal returns, then in my experience, there's almost always state withholding. 4, the state knows there is withholding, as Gabriel said, but fails to credit the taxpayer's accounts to eliminate or reduce the liability. And instead, the state bills the taxpayer for a second time for taxes that in the case of low-income taxpayers have already been fully paid, or the state fails to issue a refund to low-income taxpayers when they have paid into the system, and the state just credits the account with 0 and never notifies the taxpayer of any refunds owed. So as Gabriel said, well, the state already knows this, and in the state of Ohio, that may not be true, but actually, as we get into it in just a few minutes, they do now know this information. But still, they just sit on it. Yeah, we know the amount withheld. Yep, there's probably a refund owed. Yep, we're not going to do anything, and we're not going to tell you about it. That was the current status. So an analogy is, I mean, if you look at an electric company, for example, and you pay the electric bill, let's say to your landlord, and you get a shut-off notice for non-payment, you call the electric company and you ask for an accounting. If the electric company responds, we won't provide an accounting, and by the way, we're going to bill you for the full amount, you'd say that's ludicrous. You'd say that's theft, and it is theft under state law. But when the state does the very same act under the guise of tax, it somehow has a shroud of credulity. But it's still the same act, and I do get passionate about it, and I do think it's outrageous. So we took many efforts to resolve the problem. We, meaning all of the LITCs in the state of Ohio, wrote a letter to the tax commissioner. This was in 2019, describing the problem. And of course, there was no change, no response. Our LITC wrote and requested an opinion from the tax commissioner, requesting an opinion as to how are you to file these returns when you don't have the amount for state withholding, the state won't provide it. No response. We sent protest letters to the tax commissioner saying, hey, our particular relators, Pearson and Palm, aren't making a charitable contribution. They want their refund money back. And we received no response. So relators, Palm and Pearson, basically were able to obtain their wage and income transcripts by obtaining, that information from the IRS. The IRS had the federal withholding. Relators Palm and Pearson file their returns. They get federal refunds. The wage and income transcripts show that there's withholding for the federal. For sure, there's going to be withholding for the state. Relator Palm contacts the Ohio Department of Taxation and says, I can't get my W-2 information from my employer. They're no longer in business. How can I get this information? The state of Ohio responds as they always respond. One, we don't have this information. Two, just put 0 for the amount withheld and deal with it in appeals, which is just a total ruse because you can't beat the burden of proof requirement. So Palm and Pearson both file their returns, but instead of putting 0, they list unknown for the amounts withheld. And the state processes the returns and gave each relator 0 credit for the amount withheld and paid to the state by the employers. For Palm, they issued an assessment for 2 of the years. One of them was for about $350, including interest and penalties, and the other one was for less. And for Pearson, they never notified her of any refunds that were on the table. After all, it's Pearson's money. And we believe that Palm was in fact entitled to a refund for all years. He never received notice of any refunds due either. Instead, he receives this tax bill, 2 tax bills, in fact. So after all this, we file a verified complaint for writ of mandamus. We file it in the Supreme Court. Mandamuses are a long shot. We know this. And in particular, we seek compliance with 2 Ohio laws, which support each other in providing a system where taxpayers' accounts hopefully or theoretically are properly credited, then reviewed, then refunds or notices of potential refunds owed can be sent to the taxpayer. The 2 statutes are 5703.058. That statute really just by a lark happened to stumble upon. It has never been litigated. It's sort of an under the wire statute. The statute requires policies and procedures to be established by both the commissioner and the treasurer to ensure that all payments are deposited or credited to the proper account. The statute uses all payments, and it says credited or deposited to the proper account. We interpret that to mean individual taxpayers. The state does not. They basically interpret it to mean, business or state entities. 5703.77 supports 5703.058 and requires the commissioner to notify taxpayers of any credit account balance. And in the statute itself, it does define taxpayers, which we think clearly includes individual income taxpayers. The commissioner disputes that. We were also seeking refunds for both our relators because we believe both of them are entitled to refunds for all 3 years that they filed. In addition, we're really seeking systemic change. Not only does a lawsuit, of course, want the refunds for our relators, but we're trying to address an underlying systemic problem, mainly we think failure to comply with 5703.058 and 5703.77. We were seeking a mandamus to enforce and create the issuance of policies and procedures for the treasurer and commissioner to establish that would ensure that all accounts are properly credited. Because at this point, the state isn't even getting the information to properly credit accounts. And we were seeking a mandamus to enforce 5703.77, which requires a commissioner to issue notices of potential refund, which the commissioner does not do. We filed the lawsuit in August of 2021, and then 4 months later, on December 23rd, 2021, the Ohio Department of Taxation puts out this press release announcing a policy change. As of January 3rd, they put out another press release and they say, by the way, this policy change is effective immediately. It requires finally all employers to file W-2 forms with the state of Ohio. So now the state has the information, and that policy change is up on my wall where it will remain forever. And so that was a good policy change that I think was a result of the lawsuit. Another positive change was that the Ohio General Assembly, HB 711, was introduced, which if passed would require the state of Ohio to provide transcripts listing the amount of withholding for state income tax within 15 days to taxpayers for amounts, of course, withheld. That legislation was introduced and it has not been referred to a committee, so I'm not sure what's going to happen with that. But I believe it also was in response maybe to the lawsuit or to the press. We got a fair amount of press when we filed a lawsuit against the commissioner and the treasurer in the Ohio Supreme Court. And the other positive change is that the Ohio Department of Tax, without issuing any policies or procedures on the matter, anecdotally seems to be providing the withholding information now to taxpayers who contact the helpline. So I'm urging everyone to do that, to contact the helpline if they don't have their information, and we will be creating a big outreach effort to our VITA sites to let them know that the Ohio Department of Taxation is providing this information. Hopefully they won't renege on their current policy. It's not really a policy, their current practice, I guess. And you can see where this is going. As of last week, our action was dismissed. The defendants filed a motion to dismiss, both of them, the treasurer and the commissioner. The action was dismissed. The case is now closed. There was no decision by any of the Ohio Supreme Court judges. I think when I look at it in a more positive light, we can say at least there's no decision on the merits. So no res judicata, go at it again. Who knows? We haven't really determined our next step. There are a lot of pitfalls with whatever procedure you want to take. There is the Anti-Injunction Act for those of you who may be contemplating suing your state entity. You just need to be mindful of that. There is, of course, immunity issues. And so if you file under the federal Constitution, the Fifth Amendment, taking a property, I don't know, I think that's a dead on arrival. But you might be able to sue under, there's some other avenues, and I'd be happy to discuss that sometime if someone wants to contact me at my email address. And that's the status.
Well, you know, Dana, that's a long journey. And even though your lawsuit was dismissed and you knew it was a long shot, you did get the attention of folks so that it sounds like some systemic change was brought about. And again, it also comes back to why on earth, if the IRS is receiving the W-2 information from Social Security, why is the IRS not capturing the state withholding information and the state wages and the locality withholding information? And I don't know the answer to this. Maybe somebody on this call does. That, you know, is it that Social Security is only sending over certain fields to the IRS? Is that because the IRS only asks for that information? Is it that Social Security it's receiving the W-2, so it's receiving all of the information on the W-2. So has it just sent over to the IRS just certain fields, or is it that it's sending all the information over, but the IRS systems are designed to only capture certain fields? And that's certainly something that we're going to try to dig deeper into, and then maybe advocate for some systemic change. And beyond that, then that goes back to something I said in the beginning, then why is it that this, you know, can the states enter into information sharing agreements with the proper, you know, security thresholds where they don't necessarily have the W-2s, that they would be able to get the gross wages and the W-2 information from the IRS so that you wouldn't have this situation?
Yeah, I was when Gabriel gave his presentation, I was like, well, maybe they can put like an asterisk for if you don't know what the state withholding is, like putting the state on notice. We don't know what the withholding is, but we know it occurred because state law requires it. And, you know, then, but the state doesn't want to do that. You know, they don't want to give the money back.
Right. And I think Larry has mentioned in the thing that the same double taxation occurs in New Mexico for paper filed returns. Larry, I don't know if you're still there, but if you want to chime in, go off mute and explain what happens in New Mexico, that would be really interesting.
Well, strangely, New Mexico will accept whatever information is placed on the electronic filed return, but if someone files on paper, they must attach the paper W-2 to get credit for the withholding. Additionally, this comes up pretty often with collection cases where people haven't reported or couldn't report the withholdings. The state doesn't get any information, unlike Ohio. New Mexico doesn't get any information from employers on the withholdings relevant to specific taxpayers. So there are some workarounds case by case. A collection agent will sometimes accept copies of pay statements to prove. It's a difficult situation, just like in Ohio. And although I think our folks are a little more receptive to making adjustments, but still it's an unfair, difficult situation. And Nina, I think what you said about the IRS, that's the key. If the IRS would somehow include in the account, the wage and income transcripts, the amount of withholdings, then the problem would not exist for taxpayers who, for any number of reasons, don't get or can't get W-2s from current, former, out of business, uncooperative, whatever employers.
Mm-hmm. It's really interesting to see that that's happening. Folks from DC, I don't know that, I don't want to put you on the spot, but I'm interested. Are you getting, what are our requirements? What are the requirements about reporting actual W-2s to the Department of Revenue?
You are putting you are putting us on the spot. Like, do you know, Elena, on that?
So, you know, I know that we require, you know, the withholding to be reported. I don't know that there is a threshold off the top of my head, but I also know that at least in the District of Columbia, were someone to file a $0 return, it would correct, and somebody would get a letter saying like, hey, actually you're wrong and this is what you paid. So, you know, we do have an automated process in the District of Columbia where there should be kind of that automatic correction that would work in the taxpayer's favor, just like it would be the other way. They claimed withholding that we didn't actually receive. So, you know, certainly it seems like it should theoretically be possible to address that issue. And I wish you the best of luck in trying to figure that out.
Yeah, if they're issuing letters to say either you didn't claim withholding, you should have, or you claimed withholding you shouldn't have, then you've got a system where you've got the withholding at the state level. So, you know, you've got the figures somewhere in the system. So that's very interesting.
Yeah,
I definitely have them.
Oh, go ahead, Elena.
Go ahead.
No, on the flip side,
I was going to say the only complication that we have is when those employers are not compliant and they don't submit the information, then that certainly adds a wrinkle to it. But outside of that situation, we should have the information and we should work, you know, it should work in the taxpayer's favor if they've made payments that they didn't claim.
And I could just add, there is a wrinkle into this. Sometimes there are situations where taxpayers have gotten W-2s showing withholding, but it never actually made it to the district or another state. So that issue maybe on if the IRS gets the data. I mean, if that could, and maybe that would go a long way. This is, this group has thought more about this than I have. But that doesn't mean just because an employer put it in their system on a W-2 doesn't mean that they actually ever remitted it to the states. And that's probably something the states are going to want to confirm as well. So.
And New Jersey, I just want to call out New Jersey because they really helped prepare the survey. Yay, New Jersey Department of Revenue. But folks from New Jersey, Marita has said that New Jersey has a substitute. Marita, do you want to talk about that a minute? You put the link in the file. The IRS does have something equivalent to a substitute, which W-2, which often we've used when the employer has treated you as an independent contractor and you're saying, I was an employee, and that way it makes you liable for your share of Social Security, but you don't have to pay the employers and things like that. But Marita, do you want to talk about the New Jersey substitute W-2?
I can surely do that very quickly. I did provide a link in the chat for everyone to look at. So the employee substitute wages tax statement has been around, for 40 something years. And it does allow a taxpayer who has no access to a W-2, either from their employer or because of, as the unfortunate Ms. Pearson, her situation, good God. Anyway, and we just asked a few simple questions, which would include, how did you estimate the gross wages and the gross income tax? Give a reason why you don't have it. And as long as the withholding amounts are within, a relative risk point of what would be the normal withholding rate, it is generally honored by the Division of Taxation here. Of course, and if we're e-filing, that's one thing that, it probably would go through. The substitute wage and tax statement really comes into play with your filing by paper, and or if there's a challenge made to the withholdings because we don't have any other record or we need some other information. So this could be used in response to a statement of account or a bill.
Really interesting. Okay. So folks are talking about being able to get a duplicate W-2 from Social Security. And I think there's been some conversation back and forth about it's expensive. Others are saying that at least during COVID, when they were working remotely, they were able to get it fairly fast. So that's another thing. I do think that that's individual by individual. And it would be really nice if, if you're getting it, for example, if Vita's getting the transcripts through TaxSlayer of with the income in the W-2s, then why can't the state tax information be on that so it can be put into the W-2s at the Vita sites? And the same things for the preparers. And that just seems rational. But I don't know whether, but we will be advocating for that and digging deep into this. And right. So Gabriel's saying, yeah, I should have said that, about do the states even, in trying to get states to create, simplified filing, you do need to know your information. And that's a big obstacle, which is another thing. If the states really want simplified filing, they're going to have to change some of their procedures if they're not doing it already. So at this point, we have 15 minutes left. There's nothing that say that we need to go on, but if anybody on the call wants to add something about filing, or if any of the other folks, the panelists want to raise some issues, that's great. But I just want to thank you for this. I thought this was a really interesting discussion. In terms of e-filing, I do want to give a heads up. On November 14th, the center is going to have a tax chat about the IRS, the provision in the, prompted by the provision in the Inflation Reduction Act that directs the IRS to deliver a report 9 months from the date of enactment, describing how the the challenges and the benefits, how it would implement basically a simplified filing return and really some pre-population. And so, and electronic filing even for all, like me, I should be able to file for free. This is my mantra, e-file for free without paying someone a fee if I don't want to. So we're going to have we're going to have a tax chat. And Gabriel and one of the programmers, one of the program managers at Code for America will be there. We're going to have someone from the Federal Reserve in, I think she might be in Chicago or I forget where she is, but she worked on a Treasury Department study where they took the data from already prepared returns and tried to use the information documents that the IRS had in-house from those returns to recreate those returns. So W-2s, 1099 documents, 1098 mortgage interest statements, and then see how accurate it was comparing the populated returns, if you will, with the returns that were actually filed and some of the observations from that study. And then we will also have someone from Denmark at the University of Copenhagen, because Denmark has had pre-populated returns and basically, prepared returns. The government prepares returns for taxpayers, and then taxpayers either confirm, add, et cetera. And he's going to talk a little bit about that country's experience with it and what they've observed, and because this has been going on for them for at least, maybe 15 years. So we thought this would be a very interesting panel. That's on the 14th, followed by our regular session on the 15th. And we'll be sending stuff out, and you all who have registered will be getting notice about that chat as well. So if anybody has questions, we'll entertain it now. One tidbit idea, Melanie has an idea about suing state agencies. Melanie, you want to weigh in on that?
The Ohio case is fascinating, I have to say. And I just wanted to mention, in a team of us who were doing litigation, trying to find handles for litigation against state child care agency, to get more systemic relief rather than case by case, but also in some challenging cases where the agency had, pretty much had some written away appeal rights, et cetera. Are in our state statutes in the section on the courts and what courts had jurisdiction over what, and basic access to the courts provisions. The writ of certiorari provision allowed suing in our higher level state trial court state agencies and getting, essentially injunctive relief. The standard's pretty high, abuse of discretion, but, arguably outright error of law. And in some of these situations like Ohio, I think it would have clearly met the standard. And we've had judges, rule for us and give relief when they ruled against all our other theories of relief, but they agreed under the writ of certiorari, essentially a mandamus kind of remedy.
So I think that it's so specific to state law, and it sounds like the state has waived sovereign immunity in those examples. And that's the challenge, is where is your ability to sue the agency? And yes, we have a tax cat temporarily here. Any other comments or questions? And if not, I just really want to thank you for a wonderful program. We will be posting the recording, so if you signed in late, it will be there. And the materials are up, and I hope to see you for the future ones. We've got great panels and really interesting conversations. Okay, all, thank you. Bye.